Hey everyone, this is Brent from Wolf on Wall Street Trade. Actually, we're going to be moving to a new website soon. I actually had the name Wolf on Wall Street Trade or Wolf on Wall Street about 3 years before the movie Wolf of Wall Street came out. And as you can imagine, if you go search for my site, it's just a nightmare with Google ranking and SEO. You get the movie most of the time. So we'll have a new website coming out, and I haven't changed my prices since 2008 or 2009. So if you're a current subscriber to Wolf on Wall Street, when the new website goes live in the next, I hope, a couple weeks or so, you'll be grandfathered in at that price from way back in 2008 because I do appreciate my long-term customers and subscribers. So last week, I'm just going to pick up from where we left off last week. I was showing you the diamonds. This is the ETF for the Dow and how they already hit the measured move target of what I expected on the upside, which was based on kind of like a W base or W bottom. And coming into this week, this prior week that's just passed from last week video, I was expecting, because of this divergence in the Dow or the diamonds, the Dow's ETF, that we'd enter in kind of a consolidation pattern ahead of the Federal Reserve, which makes sense. And we also had a key payrolls report on Friday. So if you look at the 3C chart, it's confirming the Dow until we got into this new week. And now you can see this kind of price consolidation happening. So 3C worked like it should. There's still an overall positive bias on the trend chart of the Dow, and this is the 2-minute trend chart. So you can see a little bit of a pullback here and a positive bias into the end of the week. Now, it was a really, I would say, turbulent week between what happened with the Fed and what happened with payrolls. So there was two mixed messages, and we'll get to those in just a second. You know what? Because this is kind of the fulcrum of the market this week, let's just get right into that point right now. So in last weekend's video, I said to watch the US dollar. The US dollar, if it moves up, it's going to tell you that the Federal Reserve's policy statement or Powell's press conference a half an hour later is either being taken dovish or hawkish by the market. So if the dollar falls, which it actually did on the FOMC statement, because we did get in the FOMC statement a kind of nod that we are going to get that step down in rates. So in December, it is probably likely, instead of getting a 75 basis point hike, we'll get a 50. So this is the initial reaction in the US dollar on Wednesday to the policy statement. That is dovish. Okay, that's good for stocks, and stocks kind of bounced on that. Then Powell came out at 2:30, half an hour after the policy statement, and he gave his press conference. Now, I also said to my members that because of the October rally, which was just spectacularly strong, especially in the Dow, but because of the October rally, financial conditions were actually looser than the last time the Fed hiked. So my kind of thought was Powell may try to kind of talk the market down to keep financial conditions tight, because if the market's rallying, it's doing the opposite of what the Fed wants, is to tighten financial conditions to clamp down on inflation. So watch what the dollar does as soon as Powell starts talking at 2:30 right here. The dollar just jumps. Okay, so Powell was very hawkish. The policy statement was very dovish, but as kind of suspected, Powell was very hawkish, and you can see that in the dollar. So the next big thing we had was payrolls on Friday. And the reason that payrolls are important is because the Fed is looking at wage inflation as being one of the primary hangups still in bringing inflation down. So they actually want to see the unemployment rate higher. They want to see wage inflation taper off, right? The payrolls report is just a mess. There is the establishment or headline payrolls report, which beat, and then there's the household report. Now, the household report is typically considered more sensitive and a little bit more accurate, but people tend to watch that headline number of the establishment report. So I'm going to pull up a quick little thing from the website on Friday morning. And this is the early update for subscribers Friday morning. On one hand, the payrolls print rose more than expected. That's the establishment side. On the other hand, the unemployment rate rose. So how do you get more jobs, but your unemployment rate actually goes up? Wage growth slowed, and the jobless rate rose to the highest since February. So a little bit of a contradiction there. And then the Bloomberg chief economist writes, the jobs report for October sends mixed signals about the labor market. One was showing the survey robust gains, while the other shows a big jump in unemployment. Now, the payrolls report has almost always been considered goal-seeked. So you have midterm elections next week. politically speaking, you don't want to see the payrolls report looking like crap going into a midterm election. So that tends to be why I think the establishment survey is goal seeked to like political purposes, but the household survey, which completely ran in the other direction and ran in the same direction as the rising unemployment rate, just had a very different take. So let's see what the dollar did in reaction to that. So here we are back again on the dollar index. This is the original FOMC statement. This is Powell's very hawkish press conference. All right, we run forward into Monday. And there's the payrolls report. Look at the drop in the dollar. And if I go to a 2-minute chart, this is really actually a little bit longer. Let's go to a 3-minute chart. Really interesting. Look at that. All the way back down below levels before the FOMC policy statement came down. So that's really interesting. Basically, the US dollar took the payrolls report as dovish, as a good thing for the market, in that it believes that the payrolls report was much weaker than that establishment survey headline payrolls. So I'm telling you that is dovish, and I'm telling you that's good for the market. I'm going to show you why now. I'm going to add S&P futures to this. Okay, so first, let me tell you what I have here. I have S&P futures in the red and green candlesticks, and then I have the US dollar index in blue, but I've inverted the price because, as I said in last weekend's video, the S&P or stocks have had a very strong inverse correlation to the US dollar and to treasury yields or bond yields. So you can see that kind of inverse correlation here with the S&P trading lower as the dollar moves higher. Remember, again, I inverted the price of the US dollar here in blue. So let's take a little bit closer look. And here's the 5-minute chart. Again, S&P futures in the candlesticks, the inverted dollar index in blue. There's the FOMC right there. Okay, so this is the hawkish take on the FOMC. So the dollar rose and stocks fell. And then here's the payrolls report. So stocks kind of did like a little bit of a drop and then kind of moved up a little bit, shaky on that whole payrolls report. But if you look at the dollar, what the dollar did was fell. Remember, this is inverted, this blue line, the dollar's price. So the dollar fell. It's leading the S&P higher. So the payrolls report had big contradictions in it, and the market basically took it as the household survey was correct, the rising unemployment rate was correct, the drop in wage inflation or in the rate of change of that was correct. So it took it as more dovish. That is positive for the market. So you can see the dollar index inverted here in blue is kind of leading the S&P higher into next week. And remember what I said last week, or what I've been telling my subscribers for quite a while, is that for the market to rally, the US dollar either needs to stop rallying and go into consolidation or actually pull back. So if we look at the dollar on the week, this is a 4-hour chart of the US dollar. Again, now this time it is not inverted, it's just the dollar. So this is our rally in October where the dollar has been consolidating. So all this week, despite what was taken as a more hawkish Fed because of how Powell responded to questions in the press conference and then the jobs report, you can see the overall takeaway is that the dollar is still in consolidation. It's not in this rip-roaring uptrend, but in consolidation. So the dollar is in a supportive position for stocks to gain a little bit more. Yields do need to come down a little bit more, in my opinion. Now, price action is not as constructive as it was last week when we had a whole bunch of bullish kind of patterns. You can see 3,900 here is kind of more or less resistant where we come into the FOMC and the payrolls report. So it's below 3,800. It does not look as bullish as last week from a price perspective only. But if we take a look at a few other factors, one of them being my custom credit index. So this is like an equal weight index of several different credit components rather than the one I really think is the most valuable, which is HYG. But it kind of smoothed out some of the noise. So what you can see here is this dip towards the end of the week in the S&P, but credit is holding up much better. So that is a positive signal. The US dollar coming down sharply on Friday and basically erasing all of that hawkishness from Powell's press conference is a bullish signal as well. And then on 3C charts of the averages, we have a lot of bullish signals, much more bullish than I would anticipate, given how price action looked during the week, especially after Powell's press conference, which is right here. But if you look at the SPY, SPY, and 3C here in orange, it is positively diverging into this low. And we had something that looked like a little bear flag here on Thursday, and it looked like it might extend. But all of this volatility here on Friday on the payrolls report, that's really not the typical thing you look for in a consolidation. You look for kind of low volatility price consolidation in a tight range. So SPY's 1 minute chart actually looks more constructive on the week than it went into the week. So over here we had maybe a little bit of a pullback signal, and over here it's constructive. The S&P or SPY's 5 minute 3C chart is the one that first caught my attention in August, September, October, with this big positive divergence coming into last week, what I termed as kind of like a inverse head and shoulders low, with a shoulder here, head there, shoulder here, and a breakout just above it, falling back below this week. But if you look at the 3C chart, it's still positively divergent. So it was kind of consolidating in here, almost like a little bit of a bull flag. And then we saw price kind of do the same. Not quite a bull flag, maybe if it's a bigger one. But in any case, price is following the trajectory that 3C has kind of set out beforehand. As I showed you already, the diamonds were in a position where they looked like they needed to pull back because they already hit that measured move. That was this divergence right here. But on the week, it's nothing bad. It's just kind of exactly what I would expect for this kind of a pullback that we see right here. And if we jump to the slightly stronger 2 minute chart, it is still in good standing here. We have a positive divergence here at the October lows, confirming the rally. Little bit of a pullback again coming into this week as expected. But look how we end the week. Again, diamonds like leading to the upside. So pretty strong, even though they are consolidating right around that measured move target that comes out of this W base that was over in here. So that's a pretty good sign as well. Here's small cap IWM. Not the perfect confirmation I would look for, but still 3C making higher highs, higher lows with the price trend. But look again what we see towards the end of Friday. We see this leading positive divergence, IWM, 2 minute. So I think that's a pretty positive signal as well. And then finally, the one that I've noticed the most change in over the last week or so has been QQQ. I saw the same kind of thing at the bottom, the October bottom, saw a sudden change for the better in the diamonds, and then the diamonds just went on to have one of the best Octobers ever. So again, we're kind of seeing something similar. Let me show you with QQQ. I use Stock Finder, by the way, this program, because it gives me more intraday bars than any other program that I've run into, but still I'm kind of missing enough to really give this kind of proper scaling. But the point is, as prices fall after the Fed, right over here, as prices fall, positive divergence in QQQ. But this is the one that really jumped out to me. It's the stronger 2 minute chart. So let's pull that up. So over here, you can see QQQ doing its price thing, dropping, going up. It's very sensitive to yields because yields are really moving the mega caps. Yields go up, the mega caps come down. Yields come down, the mega caps go up. But look at this divergence coming into this week. This is just a very rare divergence. I haven't even named it, but it's almost kind of parabolic in that it's positively diverging into lower prices and then leading higher. So this is one very interesting development. And although we've seen the dollar come down, and right now yields and the dollar are kind of moving together because they basically represent the same thing, how hawkish or how dovish the Fed is compared to what the market has priced in. So with this kind of a signal in QQQ being very strong and the dollar coming down on that payrolls report and just erasing all of Powell's hawkishness, I would think that in short order, we would see yields start coming down with the dollar. And if that is the case, then these stocks, the mega caps and the large cap tech that fill NASDAQ 100 QQQ, should do very well. So once again, in October, at the October lows, we saw the diamonds doing this kind of thing. Very strong signal where they hadn't had anything before that. Then they had the most spectacular October of all the averages, basically historic. And now we're kind of seeing the same thing in QQQ, which needs rates to come down. So do rates come down like the dollar? I would suspect so. On Friday, after the payrolls report, The Fed sensitive 2-year yield came down, the 10-year yield went up a little bit. So it's really a very mixed bag with all that stuff that happened last week between the FOMC, the Fed, and the payrolls report. One other interesting thing to note, this is the S&P 500 in the candlesticks and VIX in blue. So extreme relative weakness in VIX on the week. The S&P was down 3.35% on the week. VIX was down 4.65% on the week. Normally, VIX should be higher when the market goes down, not lower. So if you just invert the price of the S&P 500, VIX should more or less mirror that. I'm going to invert it right here for you. So you can see it is kind of mirroring it over here, but here is the weakness in the S&P 500 after the FOMC. You would normally expect to see VIX kind of surge, not be down lower on the week, negatively diverging. So that's another interesting point that I picked up on this week. And then finally, I just want to show you a couple price candles on daily charts. So Thursday, we got a few doji stars that suggest a loss of downside momentum, like the Dow's right here, after kind of hanging around this 200-day moving average. What I was saying on Thursday night in my daily wrap for subscribers was that we do need to see a follow through day. This is like a loss of momentum, possibly a reversal candle, but you do need to see follow through. So we did see a little bit of follow through in the Dow, did not break above its 200-day, but the NASDAQ has been the weakest and the mega caps have been the weakest recently, pretty much all year, to be frank. So let's pull up the NASDAQ 100 real quick. And what we get in the NASDAQ 100 after 4 days down, we get this big bullish hammer on Friday. So payrolls report, if it was a hawkish report and like the last ones we'd seen where payrolls is rising, wages are rising, the unemployment rate is stable or falling, that would be a negative for NASDAQ 100 because that suggests rates need to move higher for the Fed to get inflation under control. But after that payrolls report, again, you see another instance here of a very rate sensitive average putting in a bullish hammer. So that is very interesting. And it just all goes back to what we see on the dollars chart, US dollar index. And again, here's the US dollar index. This is a 3-minute chart. This is just right before Wednesday's FOMC. So the drop that you see in the dollar index is a dovish reaction. That is positive for stocks. At 2:30, Powell starts speaking, and then we see the dollar index go up. That's a hawkish reaction because Powell was trying to talk the market down to tighten financial conditions, even though it looks very likely we're going to get that step down in rate hikes in December from maybe 75 points to 50. There was even a Fed official on Friday suggesting it could be as low as 25 basis points. And then we go into the payrolls report. So this is not a good sign for the market. This was, but this dollar moving higher is a hawkish sign for the market and was not good. So if we keep rolling forward and get into that payrolls report, scroll forward a little bit faster here. And what seemed like a strong payrolls report at the headline level was not a strong payrolls report all around. You see that by the dollar falling, and specifically by the dollar falling basically to levels over here before the FOMC, before Powell's hawkish take. So the payrolls report actually puts a much more dovish leaning on things, which is constructive for stocks. So we'll have to see, how things shake out. But I always tell members, when we have an FOMC or a Fed policy statement, something like that, we often get knee-jerk reactions in stocks. The dollar is usually the asset to look to. In some cases, we'll get the dollar leading stocks like we're seeing right now going into next week, and that's a positive. But the algo correlations have been so tight that a lot of times they just move together. But again, as I showed earlier, the dollar index, its weakness coming out of that payrolls report is actually a beneficial thing and kind of leading the S&P higher. So I think we could still get those S&P targets that are a little bit higher, a lot of bit higher than they are right now at this week. But last week I was saying they're a little bit higher. So I think we could still get those. We do need to see rates come down. We saw the 2-year yield come down, which again, the 2-year yield is basically a reflection of the Fed funds rate. So seeing that come down on Friday gave more credibility to this drop in the dollar, and that the payrolls report wasn't as strong as that headline goal seeked data that we got. So to wrap it up, we have kind of a supportive dollar that's still in consolidation. We have some supportive candlesticks like the Nasdaq's on Friday with that hammer, and we do have some supportive 3C charts. And market breadth is still in a good position, a better position than it was most of last year when the market was actually rallying to new highs. So I think there's still a potential for some more upside here. And I'm still leaning towards the market doing more of a kind of a sideways shuffle than up or down. So that's going to be a very choppy environment, a little bit difficult to navigate for some traders. For like swing traders, it's heaven. It's just some of the markets I've made the most money in were like lateral markets, and I was able to hit every single swing on them. So we'll see what happens with that, but I think we're in a better position than what it appeared to be coming out of Wednesday's FOMC and moving into next week. We do have a couple of key reports next week. We have the Consumer Price Index, CPI, so that's a gauge of consumer inflation. That's going to be important, just like the payrolls report is. And then we have the midterm elections. I really don't know how much they're going to move the market, but there's a potential. So November 8th, midterm elections next week, we have to look forward to. But right now, I am still leaning towards the market, putting in a little bit more upside. It does not look as great as it did last week, but it kind of went through some rough periods of the market this week with the FOMC and with the payrolls report, and kind of saw through some of the muck that was in there and some of the double talk and dichotomies in messaging. So we'll leave it at that. I hope you enjoyed the video. If you did, please subscribe. Hit the little bell under the YouTube thing so you will get updates when they come out. You'll get notifications when I have new videos out, or check out the website. Again, like I said, you can sign up now at 2008 rates and lock those in when the new website goes live. Thanks for listening, everybody. Have a fantastic weekend.